Hello investors to the monthly interaction with Canara Robeco. Let us go through how the last month was, and it was an interesting month, particularly from the perspective that we had corporate earnings growth getting reported predominantly in last month or getting concluded in last month. Let us look at first the global aspects, then the domestic macro, then the corporate earnings growth, and then valuation and view, and how our portfolio positioning is. Let us discuss them one by one. Let us start with the global macro. It hasn't changed much. Of course, we had two events in the previous month, whereby we had US change in guard, which would have its own implications on the geopolitics as well as the protectionism through tariff increases in certain countries. And second was clearly the bond yields in US actually moving up by 40-50 basis point over last 1.5, 2 months. These are the two critical events that happened on global front. Clearly, as an outcome of the anticipation that the new establishment in US is likely to be pro-growth, is likely to probably pro-corporates, likely to actually give further tax benefits to US corporates, and is likely to be effectively America first, which means putting more tariffs on the foreign countries' trade, and in turn expanding manufacturing locally. These are some of the anticipations that people have post the election outcome in US, and as a result, the global flows have reversed across the board from all emerging markets. The flows have actually moved towards US, and that's what is reflecting in the volatility that you are seeing in market. Apart from the fundamental reason that is present domestically, this question has been asked by a lot of people whether the capital flows are anything that is particular to India. Let me clarify that this is not particular to India. India, China, Korea, Taiwan, Indonesia, Malaysia, most of the emerging markets stroke some of the developed countries have witnessed outflows towards US during the last 1 month post the election outcome in US. So that has been clearly the highlight of last month. Secondly, given that there is an expectation that this is likely to be a government which is likely to be expansionary for growth, you have seen, and on top of that, the US inflation data has not been incrementally correcting as fast as it was anticipated, say 3 months back. As a combination of these two things, it has actually reflected into bond yields going up, as I said earlier, by anywhere between 40 to 60 basis point over last 2 months. So that's those are the two critical aspects. How we see this event and certain other things globally in terms of summary. One, the global growth in Europe, China remains subdued. US likely to stabilize at about 2.5% and likely to improve at the margin under the new regime. One. Second, the capital flows till the time the new establishment comes and actually puts in place the new policies and tariffs on certain countries. Probably capital flows will actually keep moving towards US from the rest of the world. That's number two, which is negative for markets, which is technical negative for markets across the emerging markets. Third, you are likely to have an establishment which is anti-war. Clearly, Trump has a very, very different position on war as against the rest of the guys. And thus, it is most likely, and that's what the consensus is, that you are likely to see basically tone down on geopolitics both in Israel-Palestine conflict as well as Ukraine-Russia conflict. Let us see how this play out. But these are the three key takeaways. And as an outcome, you have commodity prices actually softening further. As we speak, the oil prices is down to $71. Those are some of the global aspects, complex, but neither deteriorating, and there is an expectation that it will improve on at least the geopolitics front. So that's the global piece. Coming to domestic macros still remain very, very healthy. The only incremental data point, and which we have alluded to in several of our previous conversations, is that Indian macroeconomy is characterized by extremely good balance sheets but weak on growth, and that's what has started reflecting in the government reported GDP data also on Friday. Government reported a GDP growth of 5.4%, which was almost a percent lower than the consensus estimate. And why it happened, whether it is structural or tactical, that we'll also discuss through our conversation. The macros still remain healthy. Inflation cyclically up, but not to worry. It is predominantly because of food. The external position in terms of forex, in terms of current account deficit remains very, very healthy. Government fiscal deficit continues to track like probably better than what they had anticipated. The balance sheets of banks and corporates remain healthy. So none of the macros except the growth part seems to be a worry in terms of increment what was expected 3 months back and what is happening. Now the growth has been challenged because of two predominant reasons. Growth has been challenged first because You clearly had the election during which the government capex, as was anticipated, has been slowing down, has slowed down. So just to put it in numbers, the first half government expenditure has been down YOY by double digit percentage points, unlike in normal year where it will be up by a double digit growth. What it means is clearly you might get probably higher expenditure on capital expenditure side, investment side from government during the second half, and that has actually resulted into GDP slowing down to the extent that you saw in the reported numbers. The second factor was also you had very heavy monsoons last year, and those monsoons have meant that the economic activity has actually been impacted during the second quarter of the financial year. So, as a combination of these two things, weak government spending during the election and post-election, and a very heavy monsoon has led to basically economic activity which is slowing down. The silver lining is that while government's capital expenditure has been slowing down, post general election there is at the margin basically rural spending, or at the margin subsidy towards the rural or the populism has been going out up from state level, and we have seen it across the states. So put together 12 to 14 states are actually likely to spend about 2 lakh crore rupees of additional money annually on schemes including Maharashtra, Madhya Pradesh, Rajasthan, Haryana, and several of the other states where the state governments have announced some of the freebies, some of the consumption or rural benefits to predominantly towards female voters. That's one thing which is incremental positive from government side, which is a change, so as to say, because generally over last 5 years, the rural spending, the spending towards the mass consumption poor from government side was constrained to single digit growth. So that's the domestic macro. Coming to the third aspect, which is corporate earnings, and corporate earnings, as we discussed during the last month and probably even the previous months, corporate earnings continues to track lower than what was anticipated, and predominantly again the reasons are the same, that on a top down basis the government has been spending less, and monsoon was heavy, and the consumption rural part of the economy was already kind of in a way weak. So as a combination of these three factors, the earnings continue to track lower. The earnings growth during the first half has been single digit versus anywhere between 11 to 13% consensus estimates for Nifty earnings growth. So there has been a cut of earnings during the first half to an extent of 3 to 5% already. Do we see more earnings cuts? We don't. Consensus or other consensus doesn't anticipate more earnings cut, because most of these factors which we alluded to, be it government spending, be it monsoon, or some of the rural aspects, mass consumption side, it looks like they are more contextual, they are more cyclical, so they are likely to turn during the second half. And as they turn, as government spends little more aggressively during second half, as you don't have impact of monsoon, but you have probably positive impact of festivity and festivals, which predominantly fall in third quarter numbers, and you have basically the rural consumption and rural economy at the margin doing better than what it was doing over last 2-3 years, you will see recovery according to consensus during the second half of the year. So clearly there has been a disappointment on earnings. And where is this earnings disappointment coming from? Predominantly the earnings disappointment is coming from, first, global commodity cyclicals, which is energy, commodities, and second, it is coming from rural and consumption part of the economy. So within the consumption again, across the consumption board, barring very few companies, have actually disappointed in terms of earnings growth. So these are the two pockets, basically global commodity cyclicals and domestic consumption. These are the two pockets where the predominant part of the earnings disappointment has been. Where have the earnings surprised positively or been resilient? Earnings have been relatively more resilient in the pockets like auto, in the pockets like industrials, in the pockets like large lenders, in the pockets like market infrastructure plays, in hospitals, hotels, aviation, telecom, and pharma. These are the spaces where the earnings continue to be relatively more resilient. So that's the earnings piece. What is our sense? Our sense is, while the broader structure of the economy still remains in an expansion zone, whereby we are in a credit growth cycle, we are in an economic cycle, we are in an earnings growth cycle, we are in a balance sheet expansion zone. But within that, you are likely to have financial year 24, because of some of these one-offs, you might experience earnings growth which is lower than the averages. US doing at the margin better, your IT sector can come back. So that brings me to the last part. Given that we had done a lot of upfronting of valuations, the valuations multiples for India were trading at anywhere between 10-15% to 40-30% premium to their own historical valuations, depending on whether you are actually talking about large caps, mid cap, small cap. Given that context, when the earnings disappointment has happened, even if it is contextual, even if it is cyclical, you will experience the consolidation in terms of time price correction, and that's what we are right now experiencing. And this has been little more as accelerated or accentuated because of also the outflows which we are experiencing towards US from all the emerging markets. That's the situation right now. When we look at the market, clearly large caps have come back post the correction to historical valuations roughly, or 5-7% premium to historical valuations. Large caps are trading at about 20 times PE. That's about 10% premium, 7 to 10% premium to historical valuations of 18.5, 19 PE for last 10 years. Mid cap, small cap still continue to trade at 20 to 30% premium to their own historical valuation. And to that extent, we incrementally see more opportunities in the large cap basket, large mid cap part of the market as compared to small cap, mid cap from a next 1.5, 2 years perspective. Given this context, our portfolios are positioned a little more defensively, and our portfolios are positioned towards sectors where the earnings growth, superiority or resilience is present. So from a portfolio perspective, we are largely overweight in industrials, part of auto, hospitals, hotels, telecom and pharma. These are the spaces where the portfolios are overweight on. The portfolios are underweight on global commodities and energy, which is oil and gas, metals and FMCG. These are the three spaces where the portfolios are underweight on. And the portfolios are largely equal weight on large lenders, large banks and IT. These two spaces. That's the positioning from our side in terms of portfolios. I have largely covered the global macro, the domestic macro, earnings, valuation and view. Given this context, our summary of the current situation remains that the public capex has happened, which means government capex has happened very aggressively. While contextually it will come back in second half, lot of earnings delivery over next 2-3 years has to be driven by private capex happening at a relatively aggressive or relatively higher pace than what it has been happening. Has to happen driven by real estate cycle, which is in a very good shape, and has to actually happen through little bit of a reversal of consumption, which has hitherto not participated in the earnings growth story in India. So that's the summary from our side for this month. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.